Hey guys, it's Brett here with Numbers Up Finance. We're doing a market wrap for Thursday, April 18th. We're taking a look at the hourly chart here for SPY. Now, just to do a quick recap of what we went over yesterday, I'll zoom in. I talked about the volume spike we had with the sell-off in the morning. So, we take, from that bottom to the top, we see a drop in about, just shy of 0.8%. And this is some of the highest volume that we'd seen in like the last 2 weeks. Now, if you look at today, from this top intraday in the morning down towards this bottom, so from the top of that wick to the bottom of this wick, got a drop of just shy of 0.6%, and we obviously see some volume sticks here that are, running pretty close to what we saw yesterday, not off by too much. So that's definitely a note to take, our sell-offs are seeing higher volume spikes recently in the last 2 weeks, and that's definitely important for the bearish case. Now hang in here with me for a second. We're going to switch over to the daily charts. Here I'm actually going to show you the SPY ticker. Right now we're on the S&P mini future. So if we were looking at the future, it would give you a little bit of a different story. If you looked at today's candle, I'm guessing it would show a red candle because, again, the futures they trade from the night prior. So it would have started, after close yesterday. But this candle for SPY, this is the actual tradable ticker during the day. We see a pretty flat stick because that stick opens on market open and closes at 4 p.m. Eastern time when the market closes. So what's the significance of that flat candle? That means that whatever intraday selling that we saw, that we just went over on the hourly chart, was bought back into by the end of the day. Obviously, since December, the mentality has been to buy the dip, and we, obviously this, what are we at now? 24% increase. So if that sentiment still exists, from the bottom of this wick, buying back into a flat trading day, maybe we're in for another bullish swing, but that mentality can't really last forever, especially with such overextensions that we've witnessed since December. And I think that's becoming a little bit more evident with the higher volume sell-offs that we're going over on these hourly charts. Intraday sell-offs that are spiking, more people are selling than previous weeks. Definitely in favor that we're on this teetering edge of a little bit too high prices. A little bit more long term though, these daily divergences are still in play on the MACD. From the highs that we made back in late February, the MACD is still lower from there. Prices are still going up. That's our bearish divergence. Divergences aren't necessarily immediate indicators of a reversal, but they're definitely a useful tool to show you when a market is overextended and in what direction it's overextended. A market doesn't necessarily follow this technical analysis on the dot every time we see a divergence. There's not going to be a reversal right on the spot. A lot of times, if the market extends above, beyond, that's greed, what I like to think of. And anytime it sells off too much, through bullish divergences, like we kind of had back here in December, that's fear. Overselling, stuff like that. Those are the times that we, don't play with these divergences or don't play in favor of them necessarily, and that's why they're not an immediate indicator. They're more so just a trend indicator for a longer term outlook. So the long-term outlook is going to be the same it's been for a while now. I'd say we're more so due for a bearish rally than we are for a bullish at this point, especially with the divergences. Whether that bearish rally would be anything like we saw in October in this sell-off or, into late December. There's really just no way to tell the magnitude of it, but swing trading wise, definitely a bearish swing is probably more favorable, just going off of our indicators we have here in our tools and our tactical analysis. So I'm going to finish off today by going over to the weekly charts. I'll switch back to the S&P mini futures. So here on the weekly chart, we can see down on the MACD those long-term divergences that were set all the way back in January of 2018. Those divergences are still in play. Obviously, the MACD is not making any higher highs, and prices are, so those divergences are still in play. The only way this long-term outlook is really going to shift, for me, more towards the bullish side, I'd have to see these prices extending beyond the high here, 29.47 that we saw in October. Along with that, I'm going to need to see close prices, weekly closes, daily closes above that price, because close prices are obviously the most significant. But the momentum is going to have to tag along with it, so it'll have to be a pretty, some high volume buy-ins, or at least consistent, steady buy-ins over a long period of time. That's really the only way that the technical analysis is going to be more so in favor of a bullish rally beyond that point. But until then, the risk reward and a lot of our indicators favor a bearish swing in the short term here, or even in the long term. So thanks for tuning in. Be sure to check out tomorrow's video for updates. If you found this helpful today, drop a like, comment, subscribe. That's what helps us out. So see you tomorrow, and get your numbers up.